Hello, welcome to another edition of Nucleus Investment Insights. We didn't even put a topic on this for the week because I figured something was going to happen. Must admit, I didn't expect what did happen, but so there's a lot to talk about. I think we'll talk a little bit about the overall factors, but I think probably some of the longer term stuff as well is what's more important in terms of how does it look relative to what's going on. Dave and I have both been pretty busy this morning, so we haven't had a heaps of time to discuss. So some of this you're going to be hearing, I guess, live. Just a quick reminder that everything you hear today is general in nature. None of it is personal advice. If you do want personal advice, you can check the show notes and contact us at Nucleus Wealth, and we can have somebody have a chat to you about what might be right for you. With no further ado, Dave, welcome aboard.
Hello, Damo. Hello, everybody.
Yes.
Interesting times.
Yeah, that's right. Well, I thought my original title was this whole, has the dust settled yet? With the view that, look, it was, it might have been, we might have been looking at quieter markets, and obviously we have had another explosion overnight. Don't know if you want to give a quick recap.
Nothing but dust, Damo.
Yeah, that's right. Well, yes.
Big cloud of it. So, overnight was the biggest equity rally since the GFC, which is not an encouraging sign.
No. And it is important to note that you do get the biggest rallies in the middle of bear markets as well.
You do. So it's not encouraging.
Sometimes they're at the bottom of markets. Often they're just in the middle of bear markets.
Yeah. So what happened was Donald Trump backflipped on, or at least delayed everybody's tariffs other than China's, who he gave more to because they delivered their own new round, and he immediately reciprocated. And other than the 10% reciprocal tariff for everyone, which is going ahead. So obviously this is designed to give the White House time to negotiate some deals. It may also expose, I suppose, the hidden, or not very hidden, motivation that is really driving this agenda, which is China, really, rather than anybody else. Although obviously it's not as simple as that, but it does, as we look at the tariff structure today, it looks like Donald Trump's going to tax everyone 10% to fight China.
Yes,
that's what it boils down to. Which, quite frankly, I'd be happy to pay. If they ended up with some similar structure to that in the long run, I actually think it'd be a price worth everybody paying. Now, that's going to vary, obviously, from nation to nation. But if you see this as an existential struggle between liberal democracy and illiberal market economy, which is, I guess, what I'm say China is, then sooner rather than later is better, because the longer you leave it, the weaker America gets and the stronger China gets. So
yeah. So I sort of wrote down two positives from this. Is and that's one of them. Is the trade focus is now what we spoke about last week. Is the main issue is China and what they're doing in terms of the trade system, and so now the focus is on China, which is a good thing. I've got a bunch of negatives as well. We will get to the negatives. But the other positive is Trump has signaled as well that, to at least some extent, that markets do matter. Like he's got, so we know he wants to push everything to the limit, all sort of parts of his power and everything like that. And I guess the hope from a lot of people was that markets would be one thing that might tame some of his wilder impulses, in that when markets really do react negatively, he might decide, okay, he's gone too far and wind it back a bit.
Yeah.
And so I think that's your two big signals, I guess.
It is. I wouldn't overread that one. I think he had his hand forced, not so much by stocks, but by the bond market, which was starting to really get stressed in the US. But
that's when I'm saying markets. I'm not talking just your thing.
Yeah,
and
yeah,
that hasn't gone away. But I do. Let's save that one for a little bit later, actually, because that is important.
Yeah.
The other thing I think in some of the stuff you were writing this morning is worth noting as well is that when you do go through these massive rallies, some of this is the CTAs and the trend followers and people who are like happen to be really short.
Yep.
And so when these things happen, they've all taken the other side. When things start to go up, they need to go in and buy back their positions or reverse whatever they've done, and that's what gives it another leg higher.
Yeah,
and so
which is what we call a short squeeze. So yes, we're definitely into that.
Yeah, you would think most of what we saw was hallmarks of that. I mean, the other alternative to this is, from a positive perspective, is okay, he's finally come to his senses. Everything's fine. Now we're back to how things used to be, and market's going to pretty soon get back to their regular highs. I don't think that's the case, but I think that if you're a eternal optimist, you could have a view that this that no real damage has been done. Everyone expects Donald to be master of hyperbole and throw things, and it's all negotiating, and so now we can get back on with life, which I don't think is the case, and that is sort of why some of these negatives I think is worth sort of starting to run through. So Dave, I guess the first one I've sort of put down is the Chinese tariff is no longer an inconvenience, it's now a barrier. And what I mean by that is that, at 20, 30%, whatever it is, you can go, okay, gee, that's going to hurt, but I'm just going to suck up and pay it. Once you start getting over 100%, it turns into, well, it's no longer just, you now just need to seek somewhere else. Like it gets to the stage where it can be prohibitive to pay those prices. Nope, sorry, I think I've lost you on the sound there, Dave.
Sorry, you just got a bit of household noise. I think what we're looking at here is a sudden stop in US-China trade, which is pretty calamitous. We're talking 750 billion of imports in the US from China, which will suddenly, that much worth of broken supply chain into the US economy. And I mean, who knows where that's going to land, all over the place. So I would expect that over the coming weeks and months, perhaps, that we are going to see a series of calamitous warnings from companies who are caught on the wrong side of this, can't get either products or inputs to their products to supply them, or lose their distribution entirely. In the case of perhaps something like Walmart, and we're going to see a mad scramble for alternative supply, and so we're going to see, and at the same time, Chinese goods just absolutely like flooding anyone that has no barrier. So massive inflation in some areas, massive deflation in others, and
well, when you say massive inflation US, massive deflation most of the rest of the world. Yeah.
Mostly, you would think, but some inflation elsewhere, because the US is going to have to scramble to source stuff, and so if you're sourcing from where they're going to, there'll be some input inflation for you, because you've just got a gorilla that's come and sat on your supply chain. If they're moving out of China into somewhere else where you are, and so so many unintended consequences, or intended consequences, maybe we call them. I don't know. It's just it's now going to be so accelerated that a crisis, it seems to me, an economic crisis of some sort, is kind of inevitable. And I would expect to see companies falling over, at some point.
I think,
and so basically what I'm describing is a significant slowdown in the global economy, and focused on the US and China.
Mm. And there's going to be, it's not necessarily large companies as well. There's going to be plenty of small companies.
Oh, no, my God.
Just,
Yeah.
that's probably going to be worse, I think. But there'll be people out there who are just like, yeah, I make whatever, I make footballs for whatever, and I source them all from China, and so all of a sudden overnight my prices have doubled, and I can't afford to do
you
it.
won't see retailers just literally with empty shelves. I mean, like they just can't source product.
Yeah.
Like especially if you're like a category killer or someone that really sources hard from China. Like, I mean, I don't know. Like take a Kmart in Australia, for instance. They have this own brand Anko, which they do everything for, and it's unbelievably cheap. I don't know where they source that from. It's probably all over the place. But take that as a business model where you have a cheap retailer that's sourcing half its product from China, own brand stuff, and it's gone. It's literally gone. Like you got inventory and then it's gone.
Yeah, and I guess that's the good example, I guess, for Australia as well, in terms of saying, okay, how do we get affected? And this is the part where you just don't know where the ricochet ends insofar as you go, okay, let's take Anko as exactly that. Is you go, okay, they've got whatever, let's just call it, 50% in China and the rest in sort of Bangladesh and Vietnam and a bunch of other countries sort of throughout Asia. Yeah. Is it all of a sudden the Bangladesh ones are like, okay, we've got to supply the US because the US is no longer buying stuff from America because China because it's got 100% tariffs. So now the prices in Bangladesh are all being bid up. Yep. And then the ones from China are then trying to come back into Australia. And so, yeah. In an if you've got, if you said, oh, here's a staged tariffs that's going to increase over the next 2 or 3 years, and by whatever it is, 10% a month for 10% every 2 months for the next 24 months or whatever it is, pick your number. Is it?
Well, that would be a sensible way to do it.
Yeah. Then you might be able to handle it. But yeah, there's going to be a lot of this disruption, just overnight disruption.
This is being deployed like a Donald Trump. I mean, like a puffed up entrepreneurial fool, who has built an empire of blather and bluster, and you can't run macroeconomics on the principles of that.
Yeah, and the whole this is on from tonight. No, it's not. It's on from next week. No, it's on. Time, whatever. And so that's and actually, I haven't got that chart handy. You put that up, didn't you? On your I sent that to you to put up on that. The number of things that have been cancelled, the number of times he's cancelled, and so every announcement that he makes on these has need to be announced like 4 times before it finally sort of takes part. So for example,
I mean, I guess we call this art of the deal, but I mean, at the end of the day, I've always thought deal making was about meeting each other's needs. Like Donald Trump's notion of deal making is give me what I want, or I'll spit the dummy. And so I guess that the larger point to that is the negotiations are going to be volatile as well. Like it's not a genuine engagement. It's a lot of puff and bluster and is he all in or is he all out? Like you just don't know this dude. So like really
yes,
it's basically impossible to invest for this is what I'm saying.
Yeah, and it's very hard for somebody to say, all right, I'm going to completely redo my global supply chains now and spend a truckload of money doing that.
Yeah,
not knowing if nech week he'll say, hey, I'll just cut a deal.
Another outcome is you continue to source from China, but you have to pay these monstrous tariffs, and you can't pass it all on, and so you start running at a loss, or you get this huge inflation spike, or both.
Yeah,
and so I really do think we're going to see some some large corporate casualties out of this.
Yes. Well, and as I said, lots of small ones as well, where it's
yes, absolutely.
Yeah, lots of small businesses who just source stuff from China and sell it. Yeah, that's a huge business model.
Yes.
Yeah.
Yes. Yes.
Okay, so 10% global is affirmed now. So I mean, look, we knew it was coming anyway.
But I mean that just looks like it's permanent, and then they're going to negotiate over the remainder, which is the kind of made up stuff.
Yes. So I'll share two parts to that. There was I'd seen the rumor, but there was a Vertigo article. There's something that came out and went through the process of that somebody had gone through all the different chat GPT and all the AI models, and basically said, if I wanted to punish countries for trading too much with me, how would I do it effectively? How should I do a tariff on all these countries? And it basically gave the answer that all four of them gave some version of the answer that Trump ended up going with, and that all economists have spoken about as being a terrible result. But it does look as if, it looks as if somebody at the Trump regime at the last minute needed to come up with an answer, and so may well have typed it into ChatGPT, can give him a formula.
So it's a hallucination then.
And that's how we're running our economy now. But yes, that's obviously going to do damage to a reasonable number of relationships globally. And I guess it's the idea that, look, we're genuinely going through a process of resetting the global trade. So don't sort of, as much as it's out of the deal and, take one position and negotiate back, there's a lot of stuff about trust. And, I think, I don't know, if you're in a relationship that relies trust, say you're in a partnership with somebody as a life partner, and you start talking about sleeping with other people and maybe just hookers, maybe I'll just pay for it, and then if you take that as a negotiating position and you come back and now he's like, no, okay, now we'll have a normal relationship again. I think once you've broken that trust level, it's pretty hard to get it back. And there's I guess a big question about how that's going to relate to sort of global trade going forward.
Absolutely.
So
why did he backflip? I think the answer is your next dot point. To be honest.
The US government bonds, yes. Yeah. So actually, let me bring up a chart actually for that one, because that's this is this what about the Fed version, where it's saying that when we've seen in past crises, we've had this sort of, there was you had a global currency crisis and long-term capital management back in the sort of pre-2000, and then the Fed stepped in, and then your dot-com bust, and they stepped in with all this liquidity. And then you had the financial crisis, lots there. You had the COVID panic. There was a regional banking crisis. I was going to say last year, it was 2 years ago now, is it?
Yeah.
And then the question is, so what I'm showing on chart, is a US financial conditions index, which is a mishmash of a whole bunch of different factors. But what it was basically showing is that as at April 8th US time, it was basically lower than it had been at many of these other points where the US had stepped in and the US Fed has stepped in and said, okay, financial conditions have deteriorated enough, we've got to do something to help this. And the Fed was basically saying, no, it's not. Or was still saying, no, it's not stepping in. But bond yields they went from, in the US bond yields, especially at the long end, went from starting to price in a recession to actually all of a sudden pricing in much higher levels. Sort of showing, I guess, this concern that markets have over can the US pay its, will it be able to pay its debts? Is it at a path to, craziness? I guess the Liz Truss moment. There's I think I saw a stupidity premium, I think was what someone had spoken about being priced in.
Look, a lot of people have focused on the dynamics of what's driving this rather than the sort of top-down signal of it. So I think there's a bit of confusing the woods with the trees on what's going on with the treasuries. it's certainly the case that there's this thing called the basis trade, which basically appears to be like hedge funds borrow from the Fed and then buy treasuries. So it's like borrow short, lend, and then lend long. And when they get crunched by liquidity, if they're losing, say, on stocks or commodities or something, they have to sell their treasuries in a big hurry, for the margin calls or whatever. Excuse me. And so this basis trade blows up and it drives up yields. Now, you can focus on those mechanics, but at the same time, and it's fair enough to say that some of that is temporary, but at the same time, you also have to ask yourself how much signal is in this in terms of what is the damage to the credibility of US debt. And, at this point, there is some, like, we don't know how much, but there is some. So there's going to be some selling and there's going to be less buying. I'm not talking about China particularly, dumping US treasuries, which everyone's always feared. I don't think actually that's a real problem. Most of that will be collateralized. They won't be able to sell it anyway. But US households have $3.5 trillion of US treasuries. No, sorry, $2.5 trillion, and not-for-profits bring it up to nearly $3 trillion. With a tariff inflation shock, are they all going to say, "I'm buying more treasuries"? No. And the hedge funds, of course, and then there will be some foreign selling of treasuries just out of the sheer sovereign risk of what's going on. And so what's happened over the last week is this dislocation between yields and selling and falling stocks. So both which is very unusual. Normally you would get treasuries bid as stocks fell, but what we've had instead is both of them falling.
Well, initially they both fell. Bonds rose.
The week before, initially there was a bid.
And then it was this week it flipped back around
as the sort of tariff war ramped up, and so that's pretty alarming stuff in the world's reserve currency debt, and so that's, I think, somebody with some credibility and sense, who knows who it was. Maybe it was Bill Ackman. Not that he's a titan of sense, but someone on Wall Street probably gone onto the blower with Trump and just said, "Look, you're about to blow up Pax Americana. You need to back off," because the bond market was melting down. So I suspect that's what's happened. Trump more or less said that's what had happened. So what is? Well, we'll probably going to come back to the implications of those things for other assets, but again, that credibility question is still open. There's all this flux of change and stuff, and it may well just tip into the next. That's where I meant to go with it. I'm sorry. If that treasury problem persists, if we see this as an analogy with the Liz Truss moment in the UK, which is more or less what happened there, with her budget, I think it was massive tax cuts and stuff and huge deficits, and the gilt market just melted down, and the Bank of England was forced to come in and start buying the debt to stabilise things. And so if that's what happens in the US, then the Fed will maybe be forced to come in with QE, which would be, market material, right? So, if that were to happen, that would certainly be, another reason for another short squeeze, for instance.
And the irony of that as well is you're going, that you'll be facing this inflation problem, and at the same time you're facing this inflation problem, you've got the Fed.
Tossing. I think they'd be able to cut rates, but they could be buying debt. So, which of course is kind of contradictory. But so I guess the point to make here is watch debt, watch treasuries, watch treasury yields. Is the bid back in there? If it's not, as Trump has backed off and yields don't come down, don't start to reflect, what appears to be still a looming recession, well, then the Fed may need to come in, and you might get like another stock rocket before the real economy, crashes onto earnings and it all comes apart again. So I think watching the long end of the US bond market right now is about as good a canary as you can find.
Yes. Yeah. Well, and then, the other thing that I've seen sort of floating around a lot more as well in over the last week is this whole idea that, look, okay, so you're about to smash the US economy and have a growth, if it's not a recession, it's at least a pretty good slowdown in terms of growth, which is going to weaken your sort of position from a fiscal perspective anyway. There's a lot of stuff about Doge. Look, the actual amount of cuts are way less than what they claim, and they're not making any big inroads into any of the major expenses, which is interest bill, which is sort of heading up, your Medicare, Medicaid, Social Security, the military spending, like all of those are sort of pretty much the largest things you could do to try and get this under control. They're not doing anything with. And then there's talk about what they're doing in terms of tax cuts and the stimulus they're going to need to sort of get over the problems they've created of their own. And it doesn't look as if the tariffs are going to raise anywhere near the amount of money that they're going to need to try and get themselves back down to this 3%. So there's that part. And then there's this whole purging of US institutions that's if anything, picking up steam. I'll go into a little bit more detail about that. But, the question is, how independent is the Fed going to be, and how much can they be coerced? Because if you're looking at a situation where big growth slowdown, the Fed might be just basically brought. I mean, when you look around a lot of the other regimes that have done the similar thing to what Trump has done, whether it's Erdogan in Turkey or what they've done in mental blank on the guy's name in Eastern Europe. But yeah, it's basically what we're looking at is that
Orban, you mean?
Orban, yeah, is that looking to get control of the central bank as well, and Trump's obviously already trying to pressure the central bank. Is that the questions are, if you end up in that scenario, maybe you look at there's a genuine case now that the US monetary policy may not be independent. You might be running these large deficits and funding it all by the US central bank paying it. Trump's spoken before, and he's obviously been bankrupt several times about that. Debts are sort of one of these things. Maybe I should just default on debts. I think he said at one stage in his last round. So the question is, in terms of pricing, most people look at the US bond as being what's called the risk-free asset. It's sort of like this is the thing that everything gets priced off, because this is the biggest and the strongest economy in the world, and they've never defaulted before, and so we price all our models off the basis that the US won't default. And there's it's gone from being no, that would never happen to, well, we don't think it would happen, but here's a pretty clear and obvious path as to how it could happen.
Yeah, and we might end up with shitcoin.
Yeah, that's right. Paid in Doge.
Yeah. So yes, and I did have a point to add, but I've forgotten now.
But I guess my point on that front is there's a lot of assumptions made that underpin the global financial markets that is based around the idea that there is a risk-free asset, and that's US Treasuries is treated as that asset. Yeah. And it's a bit like one of the major things that sort of unraveled in the financial crisis was this idea that they've done all this pricing on the basis that, look, the central assumption within a lot of the models that caused the problems with all the CDOs and all the mortgage lending was that you wouldn't get a simultaneous downturn in all housing markets across the US. That, yeah, Houston might crash, but at the same time, New York's booming and Dallas is neutral. And whereas when when you got that model that they all went in the same direction, all of a sudden everyone's models went, oh shit, that wasn't something we factored in, and all of a sudden the all these instruments no longer made sense. And there's a lot in terms of the financial markets. There's a crazy amount that's based on this whole idea that US Treasuries are a risk-free asset. And so,
it's everything. And
yeah,
I mean, I'm not saying it's going to unravel, but something as simple as like the equity risk premium, right? If the long end of the bond curve was to jackknife, because nobody wants treasuries, then there's no way stocks would do anything but fall.
Yes. Okay, so corporate bonds. We started to see a bit of movement in corporate bonds.
We have, yeah, especially at the junk end. But I mean, a lot of that reversed last night in this sort of Uber rally or super rally. I mean, I had been watching junk bonds for a signal for when Treasury Secretary Scott Bessent was going to back off on the fiscal tightening, and we probably got there this week, but we didn't get there because of that. We got there because of the stock crash and the freak out over tariffs. So I suppose, in a sense, that's probably contributed to completing the best plan ahead of schedule. But it's not going to. If it comes through tariffs rather than through austerity, you're not going to get your 3% long bond, which is where we're coming kind of back around to the Treasury market. Yeah. So. Where were we?
Well, I guess it's more just saying, look, corporate bonds.
Yes.
One other.
Look, as we know from COVID, like the US corporates are in rude health in terms of they've termed out their debt. And that's all pretty good, but it'll certainly be pressure at the margin if this kind of continues and spreads widen further.
Yeah, and I think probably the bigger concern I'd have there as well is not, we're not going to know for a little while, but it's the issuance and when that starts to dry up, especially at the junk end, where people are like, look, I don't know what's going on, but investing, giving more debt money to risky companies is not what I want to do in this environment. And you can see that in prior crises, that's sort of often a reasonable trigger in terms of. And that sort of feeds upon itself is in so far as it, a couple of companies don't get their raisings away that they thought they were going to do, and then they start going broke, and then everyone else starts going, just a minute, that company went broke, maybe I shouldn't lend to that market either, and then it can feed on itself.
Yeah.
So no major signs at the moment, but certainly there's some early day stuff that's worth.
The other thing I was going to say about the Fed and Treasuries, etc., was, and Trump. I mean, the other thing he could do is change the inflation target. Change the Fed's constitution and lift it to basically Australia's 2 to 3 or 3. What would that do?
Well, it had a premium into it. You'd put yields up further because you'd need to.
Yeah, it would. You're right.
Need to
be running loose
adjust for that.
Yeah.
And I guess the fear
that'd be a very bad move.
Yeah, the fear at that point would actually be that that he's just going to keep chasing it higher anyway. Is that it's like, he'll put it up to 3%, and then when it's 4%, he'll in a couple of years' time he'll put it up to 4% because that's the latest one, and you've lost losing control of that. But it is worth noting as well, like this sort of purging of US institutions. Like when you go through the number of US institutions where they've lost the senior members, and not just the top, but a couple of layers of the most senior people there. Like overnight, the head of the tax was one that just was resigned because they're being asked to give all this information to basically, the tax return, all the tax return information is going to be is being sought by the guys who are trying to kick all the immigrants out, and so they're sort of resigning over that. But there's the NSA, the FBI intelligence, counterterrorism, criminal investigations, all these oversight ones have all lost their jobs, and purges have happened all the way down. And so this is the I guess the concern from here is, look, okay, he's done this to all these agencies, and you've lost sort of the oversight stuff, and media is largely cowed. There's been a number of different he's been suing media organizations over various things they did that you would think seem fine, but they're getting the media organizations are settling in court in order to effectively, it's a bit of a bribe payoff in a way. It's sort of almost a standover tactics. So the real questions next for financial markets is he going to do something similar to the Fed? It is more difficult, but there's not, there's lots of different ways that pressure can be brought, and Supreme Court stuff. Most of these are starting to, the overreach type things we've spoken about in prior times are starting to reach the Supreme Court now. So things that the Trump organization, Trump executive has done, which they seem like, constitutionally, in the past they've always needed to get Congress or the Senate to actually sign off on it, whereas he's basically just taken the view that, look, he's just going to do it and ask for forgiveness later. And so those are ending up in court. Most of the lower courts have said, no, it's not constitutional. You do have to get the laws passed. But these are starting to hit the Supreme Court now. And the question is whether he's got enough majority there. And if he doesn't have enough majority, well, does he just add a few more people to the Supreme Court in order that he does? So, all those concerns, I think, are certainly circling. And, there might still be risk case, but they're certainly not trivial risk cases. Anything else on the negatives, Dave?
Well, we probably should just tackle markets, I guess.
Yes.
Now, I haven't had time to write anything, so I'm going to have to do this one on the fly. But
actually, just to give you one more second, let me just go to a quick sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, markets.
Yeah, so I guess I would see most of these as negatives. My expectation at this point is a sudden stop in trade between the US and China, and all sorts of unexpected accidents coming out of that and culminating in major economic slowdown. Certainly slow enough to damage earnings, and all sorts of implications for earnings, from squash margins, direct to huge rises in input costs, blah blah blah. So I would think that after we get through whatever this short squeeze is, and they can go for weeks or they can go for hours, we'll be start to sort of fill the gap, as they call it, to the downside, where we've just been through what was a semi-crash with big gaps down day to day, 5 and 6%. Maybe from whenever we top out, we start to grind lower into that gap, and it's called filling the gap. I think that's my base case. So the backing off has not changed my view that we're in, for the time being, some kind of bear market. I we did have a lot of fixed interest in our portfolios leading into this, and we got a really good return on a lot of it. But I'm like, before kind of piling back into that, I want to see what happens really with US Treasuries. That's a serious concern. We haven't really seen that kind of bleed that much into the local bond market, but it was still rallying here while it was selling there. But if that does, if there's more harm done to the credibility of this zero risk asset, then bonds become more problematic as a hedge and as an asset class in and of themselves, if there's all of this sovereign risks bearing down. So I'm cautious on bonds, having done quite well out of them, when everybody thought the RBA would never cut again. The Aussie dollar is, bouncing at the moment, but I can't see how far it gets here. I mean, the sudden stop between US and China trade, or it's like pretty much worst case scenario for Australia. That one, in just about every kind of dimension you can think of, from all the way from steel to national defence. So I would expect the Aussie to roll over pretty quickly and keep falling. In fact, if those tariffs don't come off and the whole thing just decouples at pace.
That's one question we actually did have from Scott. I will get to questions. There's a whole bunch of questions in there that I will get to towards the end. But here's just noting on that same point. If China slows down, what does that mean for our jobs here, especially mining and exports? And
I was already very bearish on iron ore just because of Chinese property, and they're going to stimulate here, but they're going to stimulate without property. They've never done that before. Like, they might try and get that going a bit. Maybe they even succeed a bit, but I think that's a cooked goose. You're just not going to get the kind of surges you've had in that area before when you've had Chinese stimulus. So I don't think it's an iron ore centric stimulus that comes out of China, and you're going to have all sorts of steel tariffs going up, already are, against Chinese exports. So I still think the steel and iron ore story is pretty bearish in China, and the implications for Australia are much bigger than mining and mining jobs and mining investment. They're actually national income, the budget, and the stock market, with all kinds of income and wealth damage done.
Yeah, but I guess so. The broader message, though, is from a big picture perspective is, look, this is the same way I said that it's no longer an impediment, or it's now an active barrier to trade. Is that's going to hit China and it's going to hit them hard. Yeah. They're going to need to come out with some sort of stimulus package in order to offset this.
Of course they will. And to be honest, I think they've probably got no choice but to go with the yuan now as well, and drop the yuan, go fiscal and monetary. I think it's too big. It's too precipitous. So, that's extremely bearish for the Australian dollar as well. So yes, base metals hardly went up last night, other than copper, which has just turned into a maniac in the last year or two. And iron ore futures bounced in a healthy way, but I just don't think that's a good story. I think that's a bad story ongoing. Even with stimulus, I think that's a tough sell. I'm still very bearish on the Australian dollar, is where I was going with all of that. And so that covers, your equities, your bonds, and your Aussie dollar. The Aussie economy, who knows if we go into recession or not. It doesn't really matter. We just have a weird ass economy anyway, driven by immigration. So everyone gets poorer slowly here anyway, and it's very difficult to have a recession because you're just, stuffing people in. And that's neither here nor there to me. We'll just follow the trends overseas.
And so on a per capita basis, things are getting worse.
Yes.
Whether we manage to, when you bring in enough people in, whether you manage to offset all that or not, that determines whether we'll be in recession or not.
So you want to go to questions?
Let's just quick sales message and we'll go to questions.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
So, questions we've got. I might start with another one from Scott. Do you reckon the big super funds have got our backs when the world goes nuts like this, or are we just all too tied up in global markets?
I don't understand the question.
Well, I've got two parts. I guess what I'm saying is, are they hedging against this or not? I think there's two parts to this. One is most super funds run a relatively fixed strategy, so they don't. If you've signed up for a growth portfolio and that's 80% equities or 80% stocks and 20% bonds, that's what you get. Like, they don't change it. It's not, they don't sort of wind it up and back as things happen. So most super funds are going to be relatively would be exposed to this. They also typically they'll do a reasonable amount of hedging of some of the international stuff, and that sort of, we look upon international stocks as having particularly in times of trouble, of having an unhedged exposure really helps you, because you do see the Aussie dollar offset you in both directions. And so it does really dampen that volatility. I think we were speaking last week about how global markets were off sort of 20%ish, but the Aussie dollar had fallen 6 or 7. And so it sort of meant you're only down sort of 13 on your international versus 20 on the Aussie. But if you've hedged it, you're down the full 20. So that would typically be the case. On the flip side, though, and this is a bit of a two-edged sword. They got a lot of unlisted assets, and they won't mark to market those unlisted assets. And so what they'll say is, we own an airport, and the listed airports have all fallen by 20%, but our unlisted airport hasn't, because we just don't mark that to market. And so it's the part where eventually you'll see it. It's just a question about whether whether they're reporting the right numbers or not. And what effectively happens with a lot of these unlisted assets is they'll be reporting numbers that are too high for some time. So people who are selling out of those funds are effectively getting the higher price. You're managing to sell at the higher price, and when your money's coming in, your new money that's coming in is basically saying, well, we're buying part of this unlisted airport with your super money that just popped into the account, and you're paying whatever 20% more than what the listed versions are trading for at the moment, because we haven't changed the valuation on the books. So the swings and roundabouts with the super funds. The real underlying earnings are going to get hit pretty hard, but and that's just the nature of investment markets. If you're in more of the defensive ones, then you should have held up pretty well. Like some of the income and sort of type funds should have fallen not much at all, because the bonds would have offset a fair amount of that. Dave, you got any other thoughts? I guess you've got.
No, not really. No.
I guess some comments from Groucho Globe. Trump campaigned on introducing tariffs. So, what's the problem, I suppose?
No problem. My issue's not with the tariffs. It's with the implementation.
Yes, exactly. And I think a thought out, measured one where people, I think we spoke about this last week, a measured tariff regime where it was like, right, everyone's going to get 10%. We're going to roll it out over the next year, 2 years, 3 years. Here's what you can do to avoid it. Here's what you do to get higher tariffs. Everyone understands. Companies can then go and start making changes to their supply chains. That's the thing. As opposed to, starting at midnight. And by the way, I've just added 50% because, your leader said something I didn't like. That's the part which is difficult. And then the question as well, so he's got another question about if Trump tries to run a balanced budget, won't that take trillions of dollars a year out of the US economy? New money?
Yes, but he won't get anywhere near a balanced budget. I mean, if he did that, he got the economy. Like this was the Besant plan, was to run a much tighter budget, slow the economy, drop rates and the dollar, and deregulate and get a private sector boom going. And once we get through this tariff chaos, maybe we will get that. But I think the implementation is so dramatic and chaotic that the accident will be bigger. And so we'll have a bit of a bust boom.
Yeah. And the question is whether, given the chaotic nature now, they're going to throw more fiscal at the problem in terms of...
That's right. Because once the economy stalls, the deficit will get worse, not better, no matter how much they cut it.
Yes. So tax cuts are being... The legislation for that is being prepared, being argued about, bouncing between... that'll come out at some point soon. And my guess is there'll be a reasonable amount of fiscal attached to that somewhere. And possibly they'll have larger tax cuts to offset for all of the problems that have been going on. It'll be talked about as saying how great these, we're going to get more money in from tariffs than we ever thought. And so, for example, we talked about as China saying, hey, China's giving us more money because they've signed up for higher tariffs. And so therefore we can do more tax cuts and save more money in the long term. But the real result will be that won't happen. The tariffs will be, and as well, like all this money, all these extra tariffs, that's going to be it is taxes on the American people. So yes, it's bad for it's bad for a Chinese exporter that that they produce something for $50 and they're going to have to sell it for $100. There's going to be another $50 of added onto that, but it's not being paid for by the Chinese. It's the person who's at the US end, they're paying $100 for that product, and that's what's about to hit. And that's because it's these tend to be the cheaper products. It's actually going to hit the poorer end of US society a lot harder than the richer end as well. So your Louis Vuitton handbags are still coming in from Europe at 10% tax rate, and your cheap Louis Vuitton knockoff made in China is going to be coming in at 100% more expensive. So. Sorry, you've lost you again, Dave. So you've muted yourself.
Sorry. The knockoff may be more expensive than the original.
Yeah, I doubt it, but
No, take my point though.
Yeah. What else was say? Oh, and then the question, I guess, from David is, how can anyone invest in capital expenditure in this environment? And that is exactly the point. Is no,
you can't.
Long-term capital expenditure.
I mean, if you think about, like, as fund managers, we're like very conservatively placed, and we actually have a little hedge fund arm as well, and that's more dynamic. And even that, we're just like pulled our horns right in because it's uninvestable at the moment, and that's with just markets. We're not affected by like a real economy restructuring, and where your decisions are going to be for 5-7 years away. So those guys have got no chance. You just got to wait and see where it shakes out, like for the deals to be done and then figure out where your supply chain can be.
Yeah. While there's day by day tariffs are this much. No, they're not. They're this much. Yes, they are. No, they're not.
Yeah.
No one's making any long-term decisions. And that I guess the one positive from a real economy stage is, that's going to take some time to play out in terms of how long that takes. You smash the consumer confidence, for example, by doubling the price of all their clothes and shoes. Like that hits pretty immediately.
Yeah.
These people don't build factories every day, and so that will be a longer term negative that sort of play out over 2 or 3 years now. The next 2 or 3 years, you'll just see way less growth than you might have seen, maybe less capital expenditure. The real fast stuff is what you see from consumers. Excellent. Right. Well, I think there's probably enough. Hopefully, we won't be back again next week. It seems like Wednesday is the day. Wednesday US time has been the day that Trump decides to spring it on us. So hopefully it will be a bit quieter this week. But we will obviously keep on blogging and posting, and you can get all this stuff via the Nucleus Wealth website. Sign yourself up, and we'll pop out emails to you to let you know what our thoughts are and what we're doing within sort of our tactical portfolios around this. Thanks everyone for listening. You can it'd be great if you hit the like and subscribe buttons. And you can get Nucleus Wealth on a whole bunch of different major and minor platforms, podcast platforms. You can follow us on all the different social media. Thanks everyone for listening in. If you are listening to this afterwards, you can log on to YouTube at 12:30 on Thursdays if you do want to ask your own questions, or you can pop in some comments or email them in through to us, and we will have a look and address anything that seems interesting. Thanks a lot, guys. See you, Dave.